we are working through example 1 in the curriculum, and like many other examples in the curriculum, this is critical. You are given these exchange rates. So in this top exchange rate, what's the base currency? Yeah, in the convention, as I mentioned earlier, the euro is the base currency over here. And what is 1.4559? This is the bid in the interbank market, and this is the ask or the offer in the interbank market. What is SEK? Swedish krona. So it's the Swedish currency. They have at least not joined the Eurozone, which might have been a smart thing to do. What is the bid offer on the SEK to euro cross rate implied by the interbank market? So how would you do this? So this is basic algebra. SEK over euro. What is the common currency in between? It's the US dollar. So the way you can do this is SEK, Swedish krona, over USD multiplied by USD over euro. This was one part. The other part is we have bid ask over here. So the thing to remember is that if we are doing the bid, then the SEK to euro bid is going to be the SEK to USD bid multiplied by the USD to euro bid. No, it's all bids. So this bid is equal to this bid times this bid. There is a whole explanation to this, but I have found that trying to remember the explanation is more tedious than just remembering this fact. It's not hard to see that the bid rate, the cross bid rate, is equal to simply the product of the two bids. Can you do this quite easily? So SEK over USD bid is what? So this would be 6.8739 multiplied by USD to euro multiplied by 1.4559. So you do the maths and this will give you the bid. What about the ask? There you simply multiply this ask by, so yeah, you multiply the two asks. That makes this fairly straightforward. Yeah, now let's do the next one. Japanese yen to Canadian dollars. Let me see if you can figure this out. It's not that simple. There's a trick here. So if one advantage of these videos is you can see the questionnaire and do it and then compare the answer with the curriculum. What are we trying to do? We are doing Japanese yen divided by Canadian dollars. What is this? So how do you come up with this? So you have Japanese yen. First, let's just do the algebra. To US dollar multiplied by USD over CAD. And again, this bid will be equal to this bid times this bid. But do we have this data nicely given the way we had? No. Do we have Japanese yen to USD? Yeah. So Japanese yen, so we can actually use the 81.87. USD to Canadian dollars. Yeah, so USD to Canadian dollars, that one. So we are quoted this rate with USD as the base, but we actually need the Canadian dollar as the base. So what do we do? And again, the way you can think of this is as follows. If the base currency is USD, that means that in the interbank market is giving a bid. So they would buy for this number. 0.5944 is the price of what? It's the price of the base currency. Whenever you are given a quote, you go to the money changer and he gives you a quote of 95.3. That is the price of the base currency. Whenever you see a price on a board, that is always the price of the base currency. If the base currency is dollar, then that's the price of the dollar. If you are buying dollars from the dealer, that's the exact same thing as selling rupees. Right? You go, you buy dollars. The question is, are you buying dollars or are you selling rupees? Same thing. Right? So that's why, and that's a simplistic explanation, that's why if this is the bid for the US dollar, then the ask for the Canadian dollar would be the reciprocal of this. So if you are to come up with USD / Canadian dollars, then that quote, the bid now would become 1 over this number, 0.9546. That becomes the bid for the Canadian dollar. And what's the ask? That's the reciprocal of 0.9544. My advice to you on this is justify this to yourself once and then memorize it so you don't need to keep thinking about it, because there are enough other things to think about. So just convince yourself once and then just that's how it works. So USD to Canadian dollars. Here do you need the bid? USD to Canadian dollars, the bid is this. So then you simply multiply by 1 over 0.9546. So you multiply or divide depending on how you look at this, and you will get the Japanese yen to Canadian dollar bid, and the ask would be 81.89 into 1 upon 0.9544. All right, so that's your question 2. The next point is, and now this gets into some arbitrage related material. If a dealer quoted a bid offer rate of 85.73 / 85.75 in the Japanese yen Canadian dollar market, so base currency is Canadian dollar, then how can you have some triangular arbitrage? We are not going through all the transactions, but the point is this. You are also given this information. Based on what we just calculated in this question, the Japanese yen, what was the implied cross rate? Did we come up with an answer? It was this. So I have just reproduced this over here. The implied interbank market rate is this. So in the interbank market, I'll just put it over here. We have 85.76 and 85.50. That's the bid. That's the 85.80. Ask has to be more than the bid. This is in the interbank market. Now some dealer quotes the following. So this is what a dealer says. A dealer then is quoting this range, 85.73 and 85.75. So you look at the dealer's quote. You can also transact in the interbank market. What will you do? How much will you have to pay the dealer? Yeah, the dealer is asking for this much. So this is, you'll go to the dealer and you will buy Canadian dollars for 85.75, and then what will you do? And then you will sell it over here. So per Canadian dollar, how much money will you make? Yeah, you will make, remember the price currency is the Japanese yen. So per dollar, you will make 1/100th of a yen, which is not a whole lot, but you can multiply that by 10 billion and have a big number. So this is your basic arbitrage. Now, what does this connect with? What is going on over here? In this particular scenario, the offer in the dealer market is ending up being greater than the bid in the interbank market. This is a violation of the arbitrage condition, and this will not last. Why? Because people will do this and prices will quickly adjust. So this connects with what I was saying earlier. The bid cannot be higher than the current interbank offer, or in the cross rate sense, the cross rate bid posted by the dealer must be lower than the implied cross rate. So what we've just done is an illustration of this point. What about this? All right, so can we make an arbitrage profit or not over here? So you need to write down these numbers. Again, the implied interbank rate is 85.76 and 85.80. What's the dealer quoting? 85.75 and 85.81. Can you make a arbitrage profit here? How much will you have to pay the dealer? How many yen per dollar? 85.81. So then can you take this 85.81 and go sell it over here? You could, but you won't make any money. So there is no arbitrage. So this actually is a more expected, this is an expected scenario where the rates exist such that arbitrage is not possible. Okay, now let's see if you are paying attention to what I said earlier about bid-ask spreads. And notice how nicely the curriculum takes what sounds like a really simple concept and then gives you something like this. And for those who are weak with their geography and time zones, the time zones are given to you. I think the CFA Institute will expect you to know basic time zones though. Okay, remember what I said. What are the two currency pairs here? One is Canadian dollar and USD. Another is Canadian dollars and, does anybody know what this is? Yes, this is the Korean won. Which one do you think is more actively traded? USD, Canadian dollar is more actively traded. So now that you are at level 2, you are expected to have some basic financial general knowledge. So clearly the bid-ask spread for USD and Canadian dollar is going to be less because that currency pair is much more actively traded. So this would be probably at 3. So the question is most likely ranking of the bid-ask spreads from tightest to widest. So between these two we have tighter. Just as a side remark, 15:30 London time. Is this an active time? Yeah. This is fairly active because this is afternoon, late afternoon in London, morning in New York. So it's this time over here. So it is late afternoon in London. So where are we? So we are over here. So afternoon in London, morning in New York. This is probably the most active time. The gray means that the markets are open. So in this particular question, the time is the same, so this doesn't help you too much, but you can easily imagine a question on your exam where the times are different. Then what did I say? For a larger transaction, the spread will be a little bit wider. So that means that the tightest spread would be over here, the second tightest over here, and then you are here. So most likely ranking from the, transaction 3 is the tightest, and then followed by transaction 1, then transaction 2. So that's the correct answer.